Now let's work through some exercises that have to do with income statement, revenue recognition, and expense recognition issues, including the journal entries and knowing which time periods and understanding all the accounts involved in these transactions. Again, all of this is the accrual basis of accounting. When we get done with this Chapter 3 exercises PowerPoint, you need to go into Connect and you need to work again on Connect Chapter 3 exercises. These will again be due the next day, and I believe that will be Thursday at noon. This is the last PowerPoint you have before your exam. So on Friday you'll have an exam. Friday's exam will be Chapters 1, 2, and 3, the Chapter 1, 2, and 3 exercises, and you should have read, by that time you should have read through your chapters in your textbook as well, and you should have worked through your Connect exercises. So review your Connect exercises, review all the exercises in the chapters, review the PowerPoints. These will be the things that you'll be tested on. I don't find something obscure and put it on a test. I'm very straightforward on my exams, so as long as you understand what we're doing, you should be fine. Feel free to send me an email and use Canvas for that. Your exam will be in Canvas, and I will send you an email with more information about that exam. It is open book and open note. Let's work on some of these transactions here. It's important when you're working through the problems to note the months. So first thing, ask yourself, what month are we working in? Because they're going to tell you in which month things are related to. For example, on B here, bill a customer for a party held on the last day of July, but the bill is paid in August. So it depends on which month we are in, how you would talk about these things. On the first one, Bill's Extreme Bowling up here collected $12,000 from customers for services related to games played in July. If revenue is recognized in July, they want you to say the amount or explain why it is or isn't. And on this one, the services that Bill provided were provided in July. The rule on revenue recognition says we can record it as revenue as long as we've earned it, as long as we've done it. And Bill's Extreme Bowling Incorporated did the work in July, so they record all of it in July. On B, they're billing a customer for a party that was held in July, but the cash apparently is not going to come in until August. Do we care when the cash comes in when we're talking about revenue? No. Under the accrual basis of accounting, it really doesn't matter. As long as we expect the customer to pay, we are going to record it as revenue when we do the work. In this case, it was July. Now, the men and women's bowling leagues paid in advance for the fall season that starts in September. Well, this is a problem for us because we can't record this as revenue. Now, we really like it that they're paying in advance, though. As we said earlier, we like getting that cash in early. Now, since we are not going to be paid, we're going to have to record it as an unearned. In other words, we're not going to be doing the work, providing any services, the bowling facility to the leagues until September. We can't record it as revenue. So no revenue will be recorded for us since we're talking again about July activities. We like the idea because we're going to get cash, and you will record cash, but it'll be unearned. So it'll be a liability. Bill received $1,000 from credit sales made to customers last month. No revenue is earned in July on this one. because we have already recorded that revenue in June. So we can't double count on our revenue. We already recorded it, and in June what we did was we recorded an accounts receivable, and now in July our accounts receivable from these customers is being paid off. Okay, so no revenue gets recorded this month. The revenue should have been recorded in June. We're assuming that it was properly recorded in June. The following transactions are July activities. If the expenses to be recognized in July indicate the amount. Oh, now we're on expenses. We were on revenues. Again, you have to ask yourself, what is the month? The month of July. We paid $1,500 to have the plumbers replace a broken pipe in the bathroom. Well, we aren't really thinking about whether we're paying for how we're paying for it in these transactions. They just want us to explain whether it's an expense that should be in this month or not. Actually, the $1,500 here, this is one of these things we're going to get into later, but I would say is it depends whether we're making an improvement in our plumbing or not. If we make improvements in plumbing, we consider it an asset. If we are replacing something that breaks and it isn't an improvement, we call it an expense. So in this case, they're saying it's an expense and it's $1,500. This is an issue, whether it is an expense or an asset when we make repairs. We're going to return to it later on, so I don't want you to dwell on it now. I want you to just say, well, it's an expense, and the expense needs to be in which month. If it's something that was done this month for us, it goes in this month's business. Now, we paid $2,000 for the June electric bill and received a July bill, which is going to be paid in August. Now, it really does not matter when the cash flows out. It does not matter that we are going to pay the $2,000. We paid $2,000 for the June bill. All we're interested in is, since we're in July activities, we want to know what the July utilities are. The July utilities are $2,500. The $2,000 should have been properly recorded in June, and the $2,500 should be recorded in July. We're interested in July, $2,500. The employees that worked in July, we're paying them in July. All of it goes in this month's business. It goes as an expense in this month's business. The important rules on this one again: revenues are credit, expenses are debit, unearned is a liability, not a revenue item. So the important rules for you to memorize in Chapter 3, revenues are credit, expenses are debits, unearned is a liability, not a revenue item. So if we went through these transactions and we recorded them, which were on a previous slide, we would see that when we record the revenue and get the cash in, this is a credit to revenue. When a customer wants something put on account, we record it as a credit to revenue, a debit to accounts receivable. Instead of getting cash in, we're putting on an account. Again, we don't like that as much as getting the cash in right now. If a customer pays us cash in advance and we have not done any work, we do not get to call it revenue. It is unearned revenue. However, if we have an accounts receivable down here, and the accounts receivable presumably came about because we had revenue in a previous time period and we were not paid with cash, in the next time period when the customer pays us, we don't get to record revenue then. We record revenue when we have earned it, which was previously. Instead, in this time period, we are swapping out our accounts receivable for cash. It's an asset swap. Continuing with these transactions then, where we were talking about our expense transactions, I said this one, the $1,500, if it's making a major change to the plumbing, we would call it an asset. In this case, they are repairing, clearly repairing, so we call it a repair and maintenance expense, and it came out of cash. The next one, we are paying off our accounts payable. The next one, we have utilities expense being recorded, and well, I should say in this one, we are paying off our accounts payable for the previous month's billing. This month, we are going to need to record our utilities and record it as an accounts payable. What's going to happen in the next month? We'll have a journal entry like this one happening, and the amount will be $2,500. When we pay our employees for working for this month's work, we pay them and it's recorded as an expense. Said previously, we don't get to call this as an asset because every month we have to pay it, just like we are having to pay our utilities. And any repairs we might have, we have to pay that. We don't have anything really to show for it, so it is an expense, and it all has to do with this month, which I believe is July, so it's a July transaction, so there's no prepaids or anything involved. Now, they want us to work through this, and they also want us to come up with our net income for quick cleaners. $25,000 of stock for cash. Okay, cash, debit, common stock, credit. You should be getting very quick with these transactions. You need to work on your speed, work on how the journal entries are done, because when you get into the testing, you'll need to come up with the solutions quickly, okay? And it helps when you work through Connect. So working through Connect is definitely going to help. Working through these again and covering up the solutions, just printing out the PowerPoints, which are available to you in Canvas, will help. Incurred $600 for utilities, and I'll pay them next month. Oh, that sounds like what? What does that sound like? Accounts payable. Yep. Utility expense, accounts payable. Paid wages. Wages, salary expense, cash. Perform cleaning services on account. Now we are performing, okay, cleaning services. Sounds like revenue, doesn't it? And on account, it's accounts receivable. Some of Quick Cleaner's equipment were repaired for $150. They paid the full amount. So they didn't put it on accounts payable with this one, as they've done with others. They paid it with cash. To get to net income, and they're saying preliminary net income. Well, it's net income. You take revenues, which is the $2,800. You subtract expenses, $2,000 here. We had $600 in a previous slide, and we have $150 here for repairs and maintenance. Gives us $50. Another transaction, another company here, accrual basis again, and they provide online advertising service for another company on account. Well, service revenue, accounts receivable. They paid $50 for an ad. Now, important part about this is when does the ad run? In which month's business does should the ad be in? And this says it ran on that day that we paid it. So our expense and our cash happen on the same day. And the matching principle would have us think about advertising expense, bringing in the customers, and advertising expense being related to revenue. So this clearly is the same time period. Receive $200 cash in membership fees for the month from new customers. Cash, service revenue. Now again, it's for this month. If these customers were paying us in advance for membership for months that have not passed, or not the current month, we would call this not revenue, but what? Yes, unearned revenue, which is a liability. Have an electric bill, and the bill is going to be paid in the next month. If the bill is going to be paid in the next month, what we're going to do is we are going to show it as an accounts payable, and then we'll pay it in the future month. You're billing a customer for helping them sell their stuff. It says junk, accounts receivable, and service revenue. Again, you can go through and you can create or find out what their revenues and minus expenses or net income will be. You just go up here and take the revenues, you find the expenses. Revenues are credits, expenses are debits. So you have to memorize revenues credits, expenses debits, and what else? The other thing we had to remember, unearned. Okay? Alright, well that's the end of that. So best to you on your exam, and if you have some questions for me, go ahead and send me an email, and I'd like very much to help you with that because I do want you to succeed and do well on your